It's great to have you, and let's separate
It's great to be here.
fact from fiction right now. We are seeing declining freight volumes, aren't we? I mean, what's going on here?
No, quite the opposite. Freight flows in just every damn mode out there are continuing to go up. Now we're seeing some shift between modes. So some of the over-the-road truck is being converted to domestic intermodal, truck to rail to truck, the kind of stuff that a JB Hunt does. But we're continuing to see volumes grow. In fact, here's an interesting stat for you. Look at the import containers. Supposedly we've had all big, huge problem congestion. But you know what? We moved 18, almost 19% more containers into the country in 2021 than we did in the previous peak, 2018. Now, that said, the beginning of the year, the first quarter, the first 4 or 5 months actually tend to be the seasonally softest in that movement. Yet, in the last 3 months, we've already moved, like through the West Coast, 9% more containers through than we did in the last 3 months of 2021. So arguably, not only are things not going down, they're accelerating.
And this is consistent with what Annetta just told us last segment, how she sees the economy still having quite a lot of oomph to it as well. So why are the transport stocks doing so poorly?
Well, because the market always is trying to predict, but it over-predicts. What is steady Eddie and consistently predicts every single upturn now and predicts better than anything else downturns is freight flow, because it's the actual movement of goods, things getting made, things getting shipped, things getting consumed. It's real. It's not emotional. It's just steady Eddie because it reflects exactly what the activity that's happening in the marketplace.
We talked before earnings season when you said, look, there's a couple of names that are actually going to beat. I think you said maybe even raise. They're going to surprise to the upside. It was JB Hunt.
And they did.
Was it Martin was the other one?
That was the other one. But we saw that pattern repeated again. And those were two of the first transports to report. And we saw that pattern repeated again and again throughout the group.
Still, the group is down significantly. I mean, JB Hunt's down 22% year to date. Transports are obviously well off their highs. What are going to be the catalyst for, I mean, most of us would say, well, eventually the flows are going to catch up with the stocks. The market moves first, et cetera. Why do you think it's going to be the other way around?
That's just not true. That's just not true. The market's predicted, 40 of the last 45, 50 of the last 8 recessions. And freight flow has predicted, it's overpredicted a couple times. It's predicted 10 of the last 8 recessions. But it's predicted of consistently when it's going up, the economy's going up. And so it's steady. It consistently has allowed me to look smarter than I am about predicting the economy because I just know I can go home and touch it and trust it. What we've got on is what is fear? It's false events imagined real. That's what we have going on right now. People are conjuring up all these things that just when you look at the underlying data are just not true. So spot market, for instance, in dry van truckload, yes, it's down sequentially. It's dropped pretty significantly. It was really, really heady, spiky, and it had gotten at one point up to $2.70 a mile. Well, it's fallen all the way back to about $2 a mile. But that's still significantly above where it was pre-COVID, $1.45 a mile. So yes, sequentially, you might zero in on it and look at it and say, oh gosh, that's horrible.
Right.
But when you back up a little bit, you go,
and you think some of the same phenomenon is going on with Target here, where we're over extrapolating their kind of return to pre-pandemic levels as a sign that, the economy's collapsing?
Well, two things are happening there. First of all, if you look at their post the quarantine and then subsequent margins, they were extraordinary. They're the best margins they've ever produced, in part because they're being able to sell everything they have, everything they're getting in at full price. There's no need to, when you can barely keep the shelves full or you can't keep them full, you don't discount anything. But now when you're starting to catch up with inventory, you can, and you're not moving necessarily everything, you say, oh, well, you know what, let's put that off 10% off, 20% off. They start to discount again, just like they normally do. And they've trended back towards the more traditional margins they produced prior. I mean, let me just pull up their release real quick. That was kind of funny. I just read it verbatim. I'm not a retail analyst. What did they say? Their margin reflected higher markdown rates. First thing they mentioned. Supply chain disruptions, higher costs related to freight. Okay, that makes sense. And increased compensation and headcount at their distribution centers. Well, duh. This is not new news. But the point is, they're still on top of what were strong sales a year ago, strong sales previous quarter. They're still growing sales, but they're just going to bring margins back to where they normally are. And so whatever cost inflation was getting pushed into by retailers not discounting, that's going to go away. Which flies in the face of we got runaway inflation fears. The chicken littles out there running around with their heads cut off.
And that can create some good buying opportunities, and you think the transports are one of them. Donald, great to have you on today. We appreciate it.
Always a pleasure.
Donald Broughton, Broughton Capital.